what if you could do something materially better? I think that's really exciting. So to me, it is about hope, but it's also, those moves you can make, it opens up even more possibilities. There's just like an openness in corporate culture, in your underwriting mentality, and your views on data. Flexibility is sort of the name of the game there. If you have open architecture, if you've got access to APIs and your talent is used to dealing with them, you can deploy this stuff. The cool thing is like those tools are all there. So we don't have to wait for the 2030s to be able to do something. We can enable all of it now.
Hello, I'm Laura Drabik from Guidewire, and today I'm taking over Bryan's show, and this is the future of insurance.
Hey, before we jump into the episode, I just want to set things up. I'm not hosting this episode. I've handed over hosting duties to Laura Drabik, who's the chief evangelist at Guidewire Software, because I'm putting out a new thought leadership piece about where I think the personal auto market, and hint, hint, plus other lines too, but personal auto is where we focus, but where I think it's going in the 2030s. And Guidewire sponsored that work. And so they were kind enough to lend me Laura for a little while to grab the mic and take over the hosting duties for the show so that I could share about this new piece of work and the thinking behind it with all of you. So with that, I want to say a huge preemptive thank you to Laura. Let's jump into the episode.
Bryan, you recently put out a report on what you think the future of the auto insurance space will look like. Can you share a bit about that vision?
Yeah, definitely. And I do have to thank you for doing this. It's always fun to get on the other side and not have to be the one who's running the show. So thank you. And I know I'm in good hands. So yeah, Laura, this report, it's something that's been brewing on my mind for a while. And I think the time was just right because there have been a number of things that have really come together that suddenly, I think, make the story loud and clear. And so time was right to share it. But it's like, we've heard the whole doomsday of autonomous cars are coming. And so no one's going to own their own car, and we're all going to be zipped around in these little pods, and one day they'll be flying shared autonomous pods. And so no more personal auto insurance, right? It's all like commercial lines exposure for the pod operators, or I don't know what we want to call them. And a lot of those predictions that came in like the 2010s sort of said we'd be seeing that already. Like it was a early to mid 2020s kind of thing. Obviously, they're all wrong, at least on the timing front. Maybe like 80 years from now, we'll all fly around and no one will have personal auto coverage. But today, certainly not the case. And we're not, a couple of years off from that. While they were wrong in the timing, and I think maybe the reason of it, I don't think they were wrong on the idea that the personal auto market could be dramatically changed by some major technology developments and kind of coming together of different technologies. And so that's what I'm talking about, is for very different reasons. I think in the 2030s in particular, we will see a huge shift in what the personal auto market looks like. But I don't think it's Armageddon. I don't think the market's going away. And I think the dynamics at play are actually quite different. And the good thing about that is, while it will be a strong shift, in my opinion, because the nature of how it's shifting and why and in what ways is different from this autonomous kind of picture, it means our opportunities are different. And it means the way we can navigate it is different. Because in that autonomy world, it's like once that happens and no one owns a car anymore, and that is like, it's very far-fetched, but it certainly could play out that way eventually. What do you do? Like if you're State Farm or Geico or Progressive or whoever that, has huge auto books, if no one's buying that product, there's nothing left for you to do, right? It's Kodak, it's Xerox, those things don't exist anymore. So there isn't really a response other than shift to writing professional liability, like for the E&O aspect of it, or the commercial property, like you shift into doing something else, but that product's gone. I still think personal auto will be around for a very long time. And that means we can still compete in it as carriers that play in it today, but the nature of how we do it is different. And so that's kind of what I get into, is like, what are the drivers that are causing this? So why do I think this is actually going to happen? And I think the timing actually becomes pretty clear as you look at those drivers. And to me, the drivers are about connected cars, embedded insurance, and the push for subscription revenue, not in the insurance industry, but in the auto industry. And we can get into each of those in depth. But that's kind of worthless if we don't say, well, great, Bryan, but what do I do? So then, talking about like, how is it going to play out and what does that mean for us and how can we stay relevant? Or actually, I think we can do better than relevant for those players who are willing to embrace it. Is maybe this is that golden opportunity for you to really shine. And, personal auto is not like a huge money maker. It is because of its scale, but not because of the profitability. That could dramatically change for the better. So as kind of disruptive and unsettling as these things may be, maybe it's a good thing if you're willing to play in it. And that's the positioning that I take in this paper.
Can we dig into your 3 drivers a bit more in the paper? Give us some detail on connected cars and telematics-based insurance.
Yeah, so that's the first driver, and that's it's for the closest to the autonomy discussion, because it's about the technology that's going into the cars, and some of it is related to what enables that autonomy, but it's not about the autonomy. Connected cars, UBI, usage-based insurance, is not new. Progressive was playing around with this in the like in 2008, I think, when they started things up. So a lot of carriers have solutions like that, and a lot of them saw really strong uptake in the pandemic. So several carriers actually report over 50% of their new business is opting for the usage-based or the telematics-based solution. It's good stuff, but it's like we use it in my house. Like we opted in because our cars don't move anymore. So why not take the savings, right? You're not driving as much, and it makes a lot of sense. But those sensors, those little plug-in dongles, or the app, if you're running an app, they really just look at how far have you driven. So they could be usage based on miles, or they also look at your speed and your acceleration tied to that. So are you zipping up really fast? Are you driving too fast on local roads, or breaking the law? And are you braking hard? And different carriers take different positions on the braking hard point, but anyone who looks at hard braking views it as a negative. And I think we've all had times where we were braking hard and it was a negative. Like we weren't paying enough attention, or we lost control, or whatever it was. Actually, I just did it the other day. I wasn't noticing a cone that was pretty far out into the street. And so I had to maneuver pretty quickly. And I'm sure if we still had the dongles on our car, it would have sent a signal to my carrier that maybe they should get off risk. Nothing happened, but it wasn't a good scene. But there's other times where suddenly someone stops short in front of you, or the ball rolls out into the street, and there's going to be a child following it. So you brake hard, and it's actually a good thing. You avoided a loss. But a dongle, an app, doesn't know that. It has no context. It's really like a dumb kind of telematics. And I'm not trying to put it down, but it's really limited in what it can tell you. So your ability to do something meaningful with that as a carrier is pretty limited as well. When we move to connected cars, now you've got this wealth of sensors, and it's not just hard brake, slow, fast, how far. It's all those things, plus like, where are the windows? How loud's the radio? Is there a passenger in the car? And was the driver looking at the passenger? Because a lot of these cars now have cameras on the drivers. Were they looking down, looking at an app? The phone is connected. It might know if there was an app running or not, or like the texting app was open. And there's proximity sensors, and there's radar and LiDAR and photo, camera sensors. It would know if there was a stationary object that suddenly was in front of you. Maybe it was the ADAS features, the safety features of the car that kicked in and did the hard braking to avoid an accident, not the driver being a bad driver. So you start to add all of that in, and you get a much more developed safety score, sense of the true exposure, and you get it in real time. And that's where the high-speed data comes in. So instead of, like my carrier watched us for 3 months, we had the dongles on once a month, they updated the score, and then we got a discount at the end of the 3 months, and we sent the dongles back. That's fine, but that's not very advanced. You move to seeing what the exposure is doing all the time. That's a game changer, because now you're rating for the actual true exposure. It's not about having cheaper rates or more expensive rates. If you want to look at profitability, it's having the right rate for the right exposure. And if you get that on the carrier side, while also giving the transparency on the insured side, because they're seeing, it's like, these are all my behaviors, genuinely. I'm not guessing if you're like screwing me over on the rate, or if I'm getting away with murder by cheating you out of a discount I shouldn't have. Like, everyone is full transparency. So you move to a much fairer and more accurate and real-time adjustable rating kind of environment. That's what connected car is all about. And if you look at this is where the timing comes in. Right now, 77% of the US fleet, new cars being sold, are connected enabled. So they have the capability. Not every car, and not every car on the road that's new cars. We need the existing fleet to sort of age out. Like, there's a tail effect, just like losses kind of tail effect as they trend over time. We need some time for that to permeate into the existing car fleet more. In the US, it's just over a dozen years, the average age of car. So if we're nearing 100% of new cars having connected capabilities, the chip shortage gets resolved anytime soon, that'll help. But US fleet is near 100%. So, give that a couple more years. We hit all new cars having the capability, add 12 to that, or 12.1 is technically the number right now. And that's the point where the average vehicle will definitely have connected features. That puts us in the 2030s. And that's where I sort of started to coalesce around. It's not 2025, it's not 2030, it's some point, and it'll be a blend as cars age and get replaced. At some point in the 2030s, most cars will start to be connected. And so that means if you're a carrier who's not thinking about telematics in your rating, thinking about real time adjusting the rates, you're not only not going to be competitive because your rate's going to be based on your losses and arrears, and you're always going to be trying to play catch up, but you're going to be adversely selected against, because the only people who will opt into a traditional policy are the ones who don't want you to see how they're driving. And that's only the bad risks. And right now that's already happening, but it's not happening at the kind of scale that we could see when, every car is connected. And that's a reality we will be facing soon enough. So connected car is a huge first starting point for me. And I think it sets the timing of things because there's just a natural progression in the market to when most cars will be connected.
Bryan, I think your comments are spot on about connected cars, especially about enabling fairness. What about, though, embedded insurance?
Yeah.
You and I have talked about this
like the
before.
hashtag du jour.
Yeah, it is. Why I love it is because rather than have the customer go to find insurance, insurance finds the customer.
Yeah.
So we hear a lot about it, but why is it relevant for auto insurance?
So this is that moment where I think we overcome the greatest barrier in insurance, and that's engagement, right? Like, it's no secret, no one wants to buy insurance. They want to buy the thing that they have to get insured. And right now you can go off and get insurance lots of different ways. We're keeping this to personal auto. You can go to an agent, you can go direct, whatever, but you have to go somewhere. Even if you have a current insurance carrier and agent, all that, you still have to give them the information on the new vehicle. So there's a process. And the last time I bought a car, I couldn't take delivery for a week because of the slowdown in there. And I called my carrier from the showroom floor right before I closed the deal to let them know, give them all the info. And it still took them a week and they faxed something to fax the documents over and back. Like, that's friction in the purchase process. And for me, this is at a time where there were lots of cars to choose from and you could pretty much get any car you wanted and you can negotiate. Like, that's not the case right now. So if you're that customer whose insurer is standing in the way of the sale, dealer's going to sell it to someone else, and they're probably going to sell it for more money. It's the same thing in homes, right? Like, you're trying to get your mortgage and the back and forth with getting the insurance squared away and like what address needs to be listed for the lien holder. For whatever reason, most mortgagors don't list that on their sites. You have to call them to get it. And it's just weird. That might mean you lose that house. It's like, because there's someone who's making an all cash offer probably at the same time. And like, houses are astronomically expensive. They're only going up. Financing is getting harder right now as rates are going up. So these points of friction in the insurance process are actually putting the core asset sale in jeopardy. And I share an example in the paper from Carvana, who has a partnership that they're building with Root, where Carvana sees a material proportion of their sales fall through because they bring the car to the buyer and there's no insurance in place yet. For whatever reason, couldn't be settled in time. Carvana's not able to leave the car there. So they have two choices. They can either take the car back, so they've paid for double the transit, and cancel the sale. So they lose the sale. And I'm sure someone else would have bought it in this car market. Absolutely. Or they take the car back because they still can't leave it there. So double the transport costs, and they sit on it until the insurance is secured, which means they've got carrying costs in the vehicle, and then they deliver it again. So now they've got 4 times the travel cost for delivering that vehicle, and they had carrying costs. Like, it's not a great picture for Carvana. So for them to embed coverage from Root, it's not Root's UBI like telematics policy. It's just a standard like ISO auto policy that Root's using, but they embed it in the checkout flow for Carvana. There's no more information to enter because Carvana already has like the car, the license information, all of that. They can tie everything together. All the financing is there. It's built into your payment if you're financing through Carvana, which they also recently launched. It's simple. And if you're the buyer, you could go shop. No one's stopping you from doing that. It doesn't force you into it. But if you're getting a fair, what looks like a fair rate, it's broken down into your monthly payment, so it's manageable. It's not $1,200; it's $100. And you just get your car, and that's a big deal right now because it's not that easy to get a car. So like, it makes a lot of sense. Now start to expand that out. We see Rivian is doing that. They have a partnership with Nationwide in Cincinnati. It's one of the steps in their 12-step vehicle configuration process. We see Ford doing that with Ford Insure. GM has OnStar Insurance, Tesla, Toyota, Stellantis with Jeep and Chrysler. And it's happening more and more and more. And what you see is insurance is inserted into that checkout process. And this is where things start to get really interesting. And I'm going to sort of jump ahead to the next driver in a second, but now we're talking about car manufacturers who want to make sure they have their sale. And we have the auto insurers who right now, like in any state, minimum, I don't know, 400 carriers you can choose from. In some states, like 1,000. It's not like when you go through that checkout process, Carvana saying, great, you want to get insurance. Now here's a list that you can scroll through forever to pick, like, which carrier do you want? What limits? No, it's just click for this offer from Root, done. Rivian is just, you're getting Rivian insurance powered. I think they say like it's powered by Nationwide or powered by Cincinnati. It's just one offer. The price is already there. You click and you go on. So if you're all the other auto insurers, you're not competing for that risk. And that's where the shift in the market, it's not the Armageddon of the autonomy world, but it is really different. And it means if you're not one of those carrier partners of the automakers or the selling platform like Carvana is, then you're not competing for that risk. And you may get others, doesn't mean everyone's going to buy that way, but surely like a lot of people will because it's easy and the payments are built into whatever financing you're already doing. And it's right there and you don't risk losing the car or the home or the apartment you're trying to get if renters is baked in, like any of these things. This is where embedded, it's funny, we think about it as like it's a way to remove the friction of buying insurance, but I don't think it's really about that. I think it's about removing the friction of buying the thing you wanted to buy in the first place that you had to get insurance for, and insurance is the friction. So that really flips things on its head. And I mentioned the third thing we can talk about in a second. There's a move in the auto industry for more subscription revenue in a pretty strong way. And insurance is a subscription. I mean, it's one of the things when people were talking about the subscription economy, a lot of people are like, insurance is the original subscription, hundreds of years ago or thousands of years ago. And it's true, which means we're ready made to be built into other subscription services. And that's the last piece of the puzzle that we can talk about.
Yeah, excellent points that you provided and examples of a seamless insurance sales process with Rivian and Carvana. That was fascinating. You view subscription as the linchpin, though, in your argument of why things will change.
Yeah.
Why is that?
So the first two are enablers. It's like connected car and embedded. They're great, but why would anyone do that? So like, the OEMs, they're putting connected car features in not to power insurance. It's for their own things that they want to do. Embedded insurance, it's not to then start making insurance revenue or to take risk. I think it's about Carvana getting that, high failure rate down and protecting their core business. Or GM or, Tesla. The original reason Elon Musk was talking about insurance wasn't because I want to be an insurance company and, make float on the surplus. It's because he was saying that traditional insurers don't understand the safety benefits of a Tesla. And so they're overcharging. And it was very expensive to get insurance on a Tesla. And it's much cheaper if you're in a state that has Tesla insurance. It has to be viable. And we know the regulators will ensure that. So clearly he was onto something. It wasn't the insurance business. It was that the insurance business is getting in the way of his core business. And I think that's really interesting. The linchpin here is like, it's not an enabler, it's a must do. And that's what's going on in the auto industry. And it's really, to harp on Tesla, it's about valuation. So you look at Tesla, the first time I started to look at like the stock market valuation of the public major OEMs, Tesla was worth more than the next 10 automakers combined. That was December of last year. The market's been not very stable lately, obviously. So I expected, like, Tesla was $1.1 trillion in valuation not too long ago. It's come down since then. So I figure, like, okay, well, now it's probably like the traditionals probably didn't move very much. So now maybe it's 8 or 9 of the next to be equal to the value of Tesla. No, it's 12 now. So even with all the volatility and the supply chain issues and all that, Tesla is actually holding up better on a valuation standpoint than anybody else. The next closest from a valuation standpoint is Toyota, who sells about 10 million or builds and sells 10 million cars a year. Tesla sold just under 1 million last year. So they're 10 times bigger, and they're worth just shy of 30% of what Tesla's worth. You look at Volkswagen, who made about 9 million cars, sold 9 million cars, to Tesla's like 960 or 80,000. So they're selling about 9 times more vehicles. They're worth a ninth of what Tesla is worth. So that's an 81x difference in valuation, like on a like actual creation of value standpoint. If you look at the physical product, that's mind-boggling. And the thing is, if you're a public automaker, you can't just be like, oh yeah, that's crazy, stinks to be us. Like, you actually have to do something about that. You have tremendous pressure from shareholders and the market, from analysts, even just for your own survival. It makes you an acquisition target, or it makes you a disruption target for outside investors who are like, you're not keeping up on a value standpoint. We want to break the company up or whatever. It's not a good place to be in. So the OEMs, other than Tesla, really have to do something to get their valuations going. And they tried about a year ago. They started to say, well, Tesla's an EV maker. We are too. And so we're like all putting out these huge 2035 tended to be the years, for some it's 2040, but these huge, like, complete conversion to EV based businesses. GM was the first. It said $35 billion of new investment to get there. And their stock price went up a little, but it's since flattened back out. Volkswagen was the next. They said they're going to spend $100 billion on R&D to become an EV maker by 2026. So like really aggressive. And the truth is they're sort of fudging the numbers, because that's roughly their R&D spend from when they made the announcement to 2026 anyway. So it's not net new spend. There's a little bit of new spend, but it's generally like it's money they would have spent anyway, because they're actually a major investor in R&D. But like, you're talking tens of billions of dollars from all these OEMs to create businesses like what Tesla's doing, like EV, software, all that kind of stuff. And the market basically yawned, because like Tesla being worth more than the next 12, that's post their big EV conversion. So that didn't do it. So what we see in so many industries is a move to subscriptions. Like, software's already done that, Guidewire included, like looking at being SaaS-based, being cloud-based. It's a brilliant model. Instead of just selling the car once and then people are like, well, they make money on the repairs and stuff. Kind of, but not on the same scale. You sell the car once and you're done. Now it's like, well, can we get some sort of recurring revenue business? Apple's even doing this as we record this. Like, that's all the buzz, is that they're switching the iPhone ownership model. You don't buy an iPhone, they're going to lease it to you or rent it to you. You just always have a new one, and then they get recurring revenue every month. That's a brilliant model from a valuation standpoint. So the OEMs are looking at things like, autonomous features, Tesla full self-driving, GM Super Cruise, Ford Blue Cruise. You pay a monthly subscription. The stuff's all built in. You unlock it with your subscription. But that's not the only thing. They're doing that in lots of different ways. There's vehicle charging models for EVs that you're looking at. You subscribe and you get so many kilowatt hours a month. We've seen Sirius XM satellite subscriptions that start with the purchase of the car. So the automakers tied into that. Wi-Fi, hotspots and high-speed connectivity, like all these smart car, connected car features, they're going to be packaged together into subscription models. And then you have to wonder about the car ownership. And this is like, it's a crazy one to think about, is what do you mean I don't own my car? I just subscribe to ownership in that brand. It sounds really foreign. There are a couple of automakers who've had some success with those models already, but so far it's still really early and most of them haven't done well. But Volvo is one that you get any Volvo you want. It depends on the tier, but you have access to all of these vehicles, and you can get the XC90 if you've got to take people skiing one weekend, and normally you have like a little XC40 because you don't need as big of a car, whatever, you can swap them out. but it's got maintenance built in and it has insurance built in. So it's a subscription you're paying per month and it includes everything, including insurance. And Volvo doesn't ask you, oh, and which of these 500 carriers who are licensed in your state do you want insurance from? It's just Care by Volvo is the program and it just has insurance. So whether it's, a partnership like the Rivian or Ford checkout, and it's embedded in there, as OEMs move to subscription for their vehicles, which they really have to do, I do expect insurance to be just one of those features in whatever tier you're picking up for your subscription that month. And it's not just conjecture, because they're also making big announcements about that. So GM came out and said it. They're going to do 20 to 25 billion by 2030 as part of their 2030 strategic plan in software and services, subscription services in particular. And then they went a level deeper and called out insurance specifically as a $6 billion business by 2030. They didn't say what it would be. So they didn't say carrier, MGA, agent, broker. They didn't specify. But to be fair, whatever the model is, a $6 billion insurance business within an OEM automaker is a very big deal. That's the size of Nationwide's personal lines auto book today. So that's pretty wild. Stellantis said the same thing. So 22.5 billion in software and subscription services revenue. And then they didn't name the dollars on the insurance side, but they said specifically that includes their financial services arm that's doing vehicle leases and vehicle financing. And they just say other financial arrangements, whatever other might be here. And they said that's the perfect place to offer insurance as part of our financial services packages. It's like they're all shouting this out. So I think the first two things, connected and embedded, amazing enablers that allow for this to happen. But it's the third thing that is what I think really an imperative for the auto industry because of that valuation pressure. And even the one without the pressure, Tesla, is doing it anyway. They're actually the furthest along in this front. I think that's what's going to force the flipping of the market. And then it's one where your insurance, whether you're subscribed to your car or you own your car, it's part of your checkout. It's part of your relationship with that car brand. And it's just there. It's not something you're shopping for. So that dramatically changes the picture for car makers and for auto insurers.
So we own a Tesla and everything you're saying resonates with me. All of your examples are just spot on as like I said, a Tesla owner and driver. So Bryan, how does everything that you've just explained to us, how does this play out for insurers and what should they do about it?
Yeah. So, I mean, there's always a question of who knows and what's really going to happen. And I think there's a spectrum of possibilities from absolutely nothing. So yeah, Bryan, that's interesting and nothing's going to change. I don't think we can actually say that because things are already changing. So I think we at least know enough to say it's not going to be nothing. Equally, I don't think the other end of the spectrum where GM becomes a carrier and they have their own capital and they supplant State Farm and Allstate and whoever else. I don't think that's really going to happen because again, it's not that the car makers want to take risk. I don't think they're interested in the potential revenue from that. I think it's really about how the facilitation of risk taking right now is standing in the way of their business, and the new economic models they want to pursue would fit really nicely in a way to remove that friction. So I think it's more about what can they do that enables their core business rather than forget making cars, we're going to become an auto insurer. I don't think that's the story. So it's not, GM sets up and capitalizes its own carriers and Ford and everyone else. And similarly, I don't think they're going to set up captives. People are well, they can do it through captives. Sure, but that's sort of the same thing. They also don't have the capital for it. Technically they do, but that capital is really tied up in their physical plant and their R&D and resources and all kinds of things that they need to secure for their core business. So while they actually have the balance sheets, they can't deploy it for the statutory capital they need. So that to me is off the table. They don't want to, and they can't. And I don't think they're going to do that just with strong reinsurance backing, because actually the reinsurance industry doesn't have enough capacity to support personal auto in the US or globally. So that actually is really nice because it means there is still a place and a need for the personal auto insurers. And to be fair, this extends beyond personal, and it's actually not just about auto, but that's a whole other conversation. I think there's still a place for us. And so what I think is more likely to happen is a mix of agent broker models for the OEMs and maybe some MGA models. And that means you still need carriers. So whether they're just selling or they're selling and manufacturing product, because it's their connected cars, so they may have a better sense of what the coverage needs to be. And so they may choose to manufacture, but effectively their distribution. That's sort of the role I see the OEMs playing, which frankly is a much bigger conversation for agents and brokers out there. Is what does that mean if a large chunk of your agency revenue comes from personal auto? That's where the real threat to me lies. But I think for the carriers, you still get to play. But the question is who gets to play, because not everybody. So this is one about what seeds do you plant today that will serve you in that future state somewhere in the 2030s to different degrees at different points in time. And the best thing about this, Laura, is I don't think there's a cost to doing it. Like, yes, it may actually cost you money, but like, this isn't placing a strong bet on something that may or may not play out, and then you've lost the investment. A lot of the things that I think set you up for success are actually becoming table stakes anyway. And so that's where, like, I think this is sort of a no-brainer, that this is a moment where taking your head out of the sand and recognizing the potential disruption just allows you possibilities for whether this thing shakes out this way or that way or not at all. You're still much better off and should be a far stronger carrier because of that. So that's actually a really positive moment when it comes to embracing the disruption.
What I find refreshing about your approach is that you don't take a doomsday prediction approach. Yeah. In particular, in this paper, you don't. You're very optimistic. You're very hopeful. Why are you so positive or hopeful here?
Well, because I think there's a chance for us. Like, I don't like looking at disruption negatively. I think it's, I've said this before, that it's like the clouds are opening up and it's making room for something meaningful, like a chance to really compete versus like, who's cheaper today? Oh yeah, I'll take them. And we just trade back the same 1-2% every year. Like that's boring. And that's why like the returns aren't great in some of these lines. What if you could do something materially better? I think that's really exciting. So to me, it is about hope. But it's also, those moves you can make, which aside from accepting like, yeah, this is a possibility, let me embrace it. It's things we should be doing anyway. And if we do those things, it opens up even more possibilities. So I think it's like a each win begets the next win kind of thing. Like it's an additive situation. It's things like, having the mentality from an underwriting standpoint to live in a world where you're constantly getting new information from the exposure itself in real time and responding to that. Maybe it's dynamic pricing where you're constantly charging a different rate based on the actual exposures you're facing. Maybe it's being open to taking in lots of different data and thinking about it differently. Your view on your brand. Do you need to be front and center? Or, when I talk to Nationwide about the Rivian partnership, their brand's there, but it's not in your face. And for a company that also has a really healthy ad budget and is running national TV campaigns, that might be a hard thing for some companies to swallow. It's like, well, we just spent $1 billion on TV ads last year. Like, why would we ever do this and have our brand be secondary? Well, what if that's what the customer is actually asking for? So you can keep your brand primary and have no one buy from it, or you can recognize that there's another place for your brand and it still gets to matter, but it's different, and different doesn't have to mean worse. So there's just like an openness in your corporate culture, in your underwriting mentality, and your views on data. But then the biggest one, and you and I have talked about this a lot, is flexibility. Is like, what flexibility do you have in your systems to be able to rate dynamically? Because most people with legacy systems have no way to do that. And many people with modern systems don't either, or just may not be there yet, but there's the point of flexibility to create that with a modern, cloud-based system, API friendly. Flexibility is sort of the name of the game there. So can you work with 83 different data sources for this one policy? Traditionally, heck no, like that'll kill you. But if you have open architecture, if you've got access to APIs and your talent, your tech talent is used to dealing with them, you can deploy this stuff and you can swap it out. And you can say, for this cohort of the population, we're gonna use this data, and for this one, we're gonna use that data. And we can bifurcate like that. We can use some APIs for some folks and not for others. But that's all a point of flexibility. And the thing is, like, that does take a level of openness and flexibility in your core and your IT ethos, your deployment style. The cool thing is, like, those tools are all there. So that's the other reason I'm hopeful, is like, there's actually nothing. We can talk about blockers and inabilities and headwinds and handcuffs and all the stuff we've always talked about in insurance. actually all the pieces are there in front of us. We don't have to wait for the 2030s to be able to do something. Even if we don't know exactly what it is we're going to need to do, we can enable all of it now. So I think taking that positive approach is really the only option, because otherwise you kind of end up feeling really negative, swearing it off, sticking your head back in the sand and saying, no, I like that option where he said nothing will change. Let's go with that. Yeah, it's not really in the cards, I don't think.
I love everything that you've just said. And I also love working for a company, Guidewire, where we are that tech enabler of all of those points that you mentioned, your top 3 points in your paper of helping to enable carriers to get there. So, Bryan, I read your report. I loved it. It's stinking awesome. You're welcome. Where can other people get the report and learn more?
So people can get it at future-of-insurance.com/auto. And thank you, yes, to Guidewire, who was really gracious in supporting this effort, because it's a lot of work. And so I need that support to make these things happen. One thing I would call out about Guidewire that I think, talking to a carrier who said, we have all these digital capabilities, but we're not going to deploy anything to the customer because we don't have everything. Like we fall off a digital cliff a certain way. So we're just waiting for Guidewire to build them all. And I said, have you talked to them? Because they're not trying to build every single possible way you could interact with a customer and every data point. They're building the openness and the connectivity, because there's lots of different solutions and many we have no clue about yet. And I think that's, when you and I have talked about system capabilities, it's not like we're building this and we're building this and thou shalt use these exact tools. It's, yes, we built a lot of these things and we've had the points of connectivity and openness in that. And that's the biggest enabler, the biggest technical capability you build is, and today there are so many of these point solutions and different ways of going about it. So I do give you credit for that. And obviously you're not alone. There are others who have taken that view, and that's why you have all of those points to connect. Lots of different solutions out there. But maybe that it was a chief claims officer, maybe he's listening and he's like, oh yeah, they're not going to do that, are they? I mean, that's not the way it works anymore. It is about flexibility and connectivity, not about monolithic. I mean, go back 30 years. You had to build everything yourself, and that's just not the answer. So, for a core system that recognizes that, I think is really critical. So thank you for that. And obviously for supporting this work.
Thank you.
All right. Well, Laura, usually I do some weird closing thing where I thank the guest, but we're still here. So I'll thank you for coming on and doing this with me. It's a great help. And again, thank you to Guidewire, not just for lending you for this time, but for supporting this work. And I think it's important because we do have to change the way we look at what could be really scary, because it only stays scary if you don't engage in it. And that's kind of my hope, is that people are willing to take this in. So thank you for taking over the mic and running the show for today.
It's my pleasure. And we are over and out. Thanks, Bryan.
Thanks, Laura.